The average retiree's Social Security income is increasing by $49 measly in 2025, and you and I know that's not enough considering the massive rise in prices. In this video, I'm going to show you 3 planning techniques you can implement to solve the inflation gap, not just for this year, but to help you outpace Social Security and maximize your income and investments throughout retirement. Okay, before we dive into the solutions, you might be wondering, why doesn't Social Security seem to keep up with the true cost of living? Why do we seemingly get shortchanged after paying Social Security taxes for so many years? And understanding this makes the solutions that much more important. Well, you might be surprised to learn that this shortfall has actually been studied. And the hit to your purchasing power, what you can buy with your money, is not just in your imagination. The Senior Citizens League updates a study each year. Here's how they do it. They say, to measure this loss of buying power, the study compares the growth in the COLA, cost of living, since 2000 with changes in the price of 38 goods and services typically used by retirees over the same period. Well, this year, 2023, buying power was most impacted by the sharp increases in food items, electricity, rental housing, a 16% increase in the cost of dental care, as well as repair and maintenance costs of motor vehicles. What it comes down to, Social Security grants income increases on a price index really meant for working people, and retirees just spend money differently. And here's their latest finding. The latest research on the buying power of Social Security benefits finds that older adults who retired before 2000, now age 85 and older, have lost 36% of their buying power and would need an extra $516 more per month. That's $6,200 more in 2023 than they're currently getting to maintain the same level of buying power in the year 2000. So what can you do? Because 36% is a large number. But this is what's important. You get to 36% because it adds up little by little. Retirees are falling behind year after year, and that hole is getting bigger. I'm going to illustrate 3 retirement planning techniques we use with our clients here at 1 Degree Advisors to give them the best chance of success throughout retirement and outpace that income gap that we can expect from Social Security. Okay, what I can't spend my time on in this video are things like cutting expenses or working a part-time job or a side hustle. I'll just say, if you need to, you should look for any waste in your expenses. That only makes sense. And a little work to supplement your income may not be a bad idea. But let's get into planning technique number 1. So if you have savings, investments, IRAs, you've probably heard that you can safely withdraw 4% of the value. But what if you can actually spend more? What if you need to withdraw more to meet your expenses? Does this spell doom? Not necessarily, and I'm going to show you why. Or better yet, I'm going to show you how. There's nothing wrong with the 4% withdrawal rate as a general rule. It's a good starting place, but there's a better way that can potentially increase your withdrawal rate as long as you know when to potentially tighten the belt. So let's dig into the retirement income plan of Jack and Jill. They have assets of about $1 million in their investments. That's $300,000 in a taxable account, $120,000 in a Roth IRA, and then another $600,000 in a pre-tax IRA. More on the actual investment allocation in a minute. They have $45,000 in a bank account, and then they also have a house that's worth $900,000. You can see over here that their income is a little bit tight with their expenses, and we're looking to increase the withdrawal rate. So here, if we take a look at their income, they have $4,700 combined coming through Social Security. Jill has a small pension of $600 per month, and portfolio withdrawals can be near $4,300 per month. If you're quick with math, you might realize that's more than the 4% withdrawal rate. It's closer to 5%. And here's the key to making this work. We create guardrails, and it's based on their portfolio values. So if we look here, they again have about $1 million in their total investments. And based on that 5% withdrawal rate, if their portfolio increases from $1 million to about 1.2 million, we can see that they can then get a raise. However, if it goes in the other direction and their portfolio goes down to, in this case, $746,000, and that includes the market potentially dropping plus the income that they're taking, they would then need to be prepared to tighten the belt a bit. So let's take a look at some historical instances to see how their income would have been affected. So let's go ahead and start with the Great Financial Crisis in 2008. What we could see here is their portfolio would have held up relatively well. In fact, when we got to really the bottom of the market in just about March of 2009, they would have come very close to that bottom guardrail, but we can see up here that their income would have stayed relatively consistent. Okay, so let's look at a second period of history, the stagflation era. This is in the 1970s. Inflation was relatively high. And what we can see here is the portfolio actually would have held up pretty well. It would have come close in a few instances of hitting the upper or the lower guardrails. In fact, they did get some increases, and they get to a point where actually their income is higher than even what they would expect. And then in that case, when they hit in the mid 90s, before the market really took off in the 90s, they had a slight decrease, and that's over in this area over here. Now, if you're wondering, okay, I know an amount I can withdraw, but which account do I withdraw from? Well, you'd be on the right track, and that's because this is a tax question, and many retirees simply don't take seriously the tax consequences of where they withdraw their money. The reality is many retirees are leaving the IRS a tip because they're not planning properly. This then cuts down on that net income. They withdraw arbitrarily, or they mistakenly withdraw from whatever account will give them the least taxes to pay this year without regard to the long term. In other words, they leave this giant tax bomb waiting when their pre-tax IRA accounts and those forced required minimum distributions in their 70s significantly increase their tax bill when they really need the most income. So let's go back to this retirement income plan for Jack and Jill. I've analyzed for the optimal withdrawal order. And what we really started with was a default of taking from the taxable account and then the tax deferred IRAs and then the tax-free Roths later. But they're on pace to overpay in taxes by $155,000. Well, what we could do is we could basically flip that around and use a simple Roth conversion strategy in those early years up to the very low 12% tax bracket. While they're doing this, they can still withdraw from the taxable brokerage account for income. But tax planning doesn't need to stop there, and it's needed to make up that Social Security gap. Now, Roth conversions, while talked about a lot, are one technique that makes sense depending on where you fall in the tax brackets. I mean, really, you should evaluate techniques like charitable giving through your IRA when you're over the age of 70 and a half. If you're already giving charitably, this can be so valuable. And we often find that just by shifting where our clients are giving from, so from the IRA instead of writing a check, they can save thousands of dollars in taxes each year, and this can help the bottom line. Other tax savings techniques like optimizing taxable versus tax-exempt interest in those taxable brokerage accounts, tax loss harvesting to offset capital gains. Well, these techniques can keep more in your pocket. And then having a good financial planner who focuses on tax planning work in collaboration with a smart and cooperative CPA tax pro who can help can do wonders. Now, when it comes to an investment plan and taxes, far too many people, they separate the two. When we meet with potential clients, we ask them for a copy of their tax return. And I sometimes get that puzzled look. They say their previous advisor has never asked for that before. Why do we need it? And I explain that we can't possibly know how to invest their money without knowing how taxes will affect their returns. After all, it's not just what you make, it's what you keep. And so getting the investments right can allow you to keep more in your pocket and help make up that cost of living gap. And that starts with the building blocks of your investment plan, your asset allocation. Many people simply don't find the optimal split between those growth assets and the conservative assets. You likely should have both, but so many retirees end up either way too aggressive and they face risky situations, or even more common, they're too conservative and they're leaving growth, those investment returns, on the table and then falling behind inflation. They're doing to themselves what Social Security is already doing to them. And simply applying a traditional 60-40 split, 60% stocks and 40% bonds and cash, it might be good for you, but how do you know? So the key is this. First, understand how much income you need from your portfolio each year. So let's say you need $3,000 per month from your investments as income to hit your bank account, just as an example. And after we do the math for simplicity, let's say you actually need to take out $4,000 before taxes. So that's $48,000 per year from your investments. And again, to keep the math simple, let's say you have a total investment portfolio of $1 million. So if you're withdrawing $48,000 per year, that's 4.8% withdrawal rate. So here's the question. How many years of income do you want set aside in cash and bonds for when, not if, stocks take that nosedive? Well, here's some information that might be helpful. The average bear market from peak back to peak lasts an average of 3 years, and the longer ones around 7 years, like in 2000 and back in the 1970s. Because what you want to protect yourself from is having to sell stocks when they're beaten down 30 to 40%. You'll want to wait it out and allow them to recover their value. Well, having cash and high quality short to intermediate term bonds, which can be more stable in value typically, allows you to wait out that bear market. You're doing this to establish what you need in that war chest, your conservative bucket, so your income is taken care of. And then you can more confidently invest the remainder for growth, knowing you don't need to touch it until much later. Now, you get to decide how to split that up. If you're more conservative, you may want 7 to 10 or even more years in the conservative buckets. So if we go back to our example, let's just call that 4.8% withdrawal rate and even 5%. If you're conservative and want, let's say, 10 years set aside, well, that's 50% in conservative, and then that leaves 50% for stock and growth investments. Now, you understandably give up some growth potential, but now you can confidently move forward when the market turbulence comes because you have a well thought out plan. And if you're more tolerant of market risk, you may keep 3 years or so in the conservative buckets, which leaves even more for stock. You need to determine the right mix. So we help our clients dig into this based on their income needs, their risk preference, and their overall financial plan, making it all align with the objective of finding that right mix specifically for them. Getting your investment mix right is so important to solve the Social Security gap and then outpace inflation with your money. Well, this concept of aligning your investment plan with your income needs, I dedicated an entire video walking you through the exact steps and considerations and showing you why, if you're relying on only risk tolerance and age, you're doing yourself a disservice. So whether you have $300,000 saved, $3 million, or $6 million, you'll want to watch that video next. And if you'd like to talk with a CFP on my team, we always start with a simple, no obligation call to see if we're a fit to guide you through retirement. We'd love to talk to you. Just click on the link in the description. Thanks so much for watching.